Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 199 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to continue our conversation on index funds. This week has been all about index funds. And today, we are specifically going to be talking about the tax efficiency of index funds because when we are investing, we want to minimize our tax burden if at all possible. And we're going to talk about just how index funds perform in this particular area of tax efficiency and how you can use them in particular accounts to minimize your tax burden over time. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, and be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan that's specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.mnowithdylan.com, click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So a big issue surrounding our investments is taxes, okay? People are constantly trying to keep from paying taxes with their investments. And there's absolutely nothing wrong with that. If you can do it in a legal manner, then keeping yourselves from paying any extra taxes than you have to is perfectly fine. We call that tax efficiency, right? Which is what we're going to talk about today in relation to index funds. But we can invest in all different types of things that can keep us from paying taxes or can keep us from paying taxes at a certain point when we would have to pay taxes otherwise. For instance, we talk all the time about traditional and Roth IRAs. Well, traditional IRAs, they make it to where you don't have to pay taxes now on the money that you contribute, but you'll pay taxes later on when you take the money out. But you don't pay any taxes on the growth, or at least until you take that money out, and you obviously have to pay income tax on any of your withdrawals there. Roth IRAs, right? You put in money that's already been taxed, but there's zero taxes on the growth, and you can take out that money after age 59 and a half with absolutely zero taxes. Then we've talked about the HSA, right? The HSA, the triple tax advantage HSA, where you put money in that you get a tax deduction for, it grows tax-free, and then you can take out the withdrawals tax-free if used for qualified medical expenses, right? So that's another vehicle through which we can minimize our taxes. We've talked about different savings vehicles for your children's school to where you could get some tax deductions and some tax help there. There are just so many ways that people try to go about minimizing taxes. Another is municipal bonds, right? Municipal bonds, you can save on taxes by owning municipal bonds because the interest is tax-free, right? So all these different things, all these things that investors are trying to do to not pay taxes. Why? Because the more you pay in taxes, the lower your net returns are, right? If I'm contributing to a Roth IRA over a long period of time and I end up with, let's say, $2 million in a Roth IRA at retirement, well, that $2 million is going to be completely tax-free, which is extremely advantageous to me as an investor. But if I'm investing in, let's say, a traditional IRA, yeah, I'm getting tax breaks as I'm contributing, but you get to the point where you actually have to take the money out to live on, and you're having to pay taxes on all of the money that you take out, right? So trying to minimize your taxes is a really, really big deal, and people are having to constantly determine what the best investment strategy is for themselves in order to do so. Okay, we know that within like brokerage accounts, that's where we really have to work on our taxes. We really have to make sure that we are very tax efficient within normal brokerage accounts because there are no tax advantages to brokerage accounts because you can put in as much as you want to and you can take out as much as you want to at absolutely any time. And in being able to do so, all of the gains that you have are going to be taxable. And we try to make sure that we don't pay too much in short-term capital gains. We try to get those long-term capital gains where we hold things for more than a year and then pay taxes on the gains then, right? And we are also trying to have investments within things like the brokerage account that will allow us to pay as little in taxes as possible. Because if you own, say, a mutual fund that pays a lot out in distributions from time to time, you will have a much larger tax bill at the end of every year. Or if you have a fund manager that likes to do a lot of buying and selling, then you will have a larger tax bill at the end of every year. So all these things are important to keep in mind. And they also apply to index funds. right? So all those things that we talked about, index funds can play right in the middle of them, because you can put index funds in just about any type of account, right? And index funds are a particular type of investment that are going to have distinctly different characteristics when it comes to tax efficiency than do other investment vehicles. Okay, so let's talk first about mutual funds and ETFs and just how they work when it comes to taxes. Okay, because if you understand how mutual funds and ETFs work, it naturally goes into index funds because index funds are held almost all the time via mutual funds or ETFs. So just as with any individual securities like stocks, bonds, whatever you may purchase, when you sell shares of a mutual fund or ETF, that's an exchange traded fund for those of you guys who may be new or don't know. So if you sell shares of a mutual fund or an ETF for a profit, you'll owe taxes on that, what we call a realized gain, because you can make gains on whatever it is. The price of any individual stock or an ETF or a mutual fund or whatever can go up, 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 up. And as long as you don't sell and what we call realize that gain, then those are called unrealized gains, and there are no tax implications to unrealized gains. But let's say you do sell, you realize a profit, and you have that realized gain. Quite clearly, we'll owe taxes on that gain if it's held within the traditional brokerage account, right? But you may also owe taxes if the fund realizes a gain by selling a security for more than the original purchase price, even if you haven't sold any shares. So what's this mean? This means if you have a mutual fund or an ETF that holds individual stocks within it or individual bonds or individual securities within it, and they sell those individual securities for some gain, then what will end up happening is the fund will pass those gains on to the investors of the fund, therefore increasing your taxable income, increasing your tax bill based on the fact that they made those sales. Now, not just your taxable income because something may be sold at a longer term capital gain, but nonetheless it will increase your tax bill. Okay, so what happens when the fund passes on the gains? This could lead to several scenarios that might surprise you. In a down market, shareholders often take money out of funds, meaning the fund manager has to sell some of the fund's holdings to meet demand. If the fund sells lots with large built-in gains, this could lead to net gains, which you'll be taxed on, even if your fund's share price went down during the year. So this is a big bummer that occurs within any type of mutual fund or ETF when the market's going down and everybody sell. Well, the fund manager is having to come up with the money to meet all of the demand for the selling. Well, in doing so, he or she may be selling whatever is in the fund, whatever individual securities they own within the fund. Well, in doing that, what they may be doing is locking in gains, realizing gains that you are going to have to pay taxes on, even if the price of the mutual fund or ETF has gone down. So that could be a particular issue. Also, you might buy shares of a fund that realizes capital gains soon after you purchase, in which you'll owe taxes on these gains, even if you haven't been invested long enough to benefit from those particular gains. So again, there can be selling that goes on within the fund shortly after you purchase, right? Because there is no statute of limitations on ownership to where you don't realize gains until after that point. No. You are still going to have to realize those gains even if you haven't been invested that long, which is a potential bummer, right? But on the flip side, capital gains are considered to be short-term or long-term based on how long the fund held the securities being sold. So even if you have held something over the short term, right, and the fund held something for more than a year, the fund held something over the long term, and they realize a gain for whatever security that may be, then you will still realize a long-term capital gain, not a short-term capital gain, which can be beneficial. Okay, so the bottom line is, if taxes are a concern, it's a good idea to look into a fund's unrealized capital gains before investing a large amount and find out whether a capital gain distribution is imminent. Okay, you may also want to consider investing in index funds, which is what we are talking about today, because those do have specific tax advantages to them that the actively managed mutual funds or ETFs may not have. Okay, but you need to understand that when you go about buying funds, there are tax implications, and they are not all reliant on you. They're not all reliant on the buying and selling that you do. They are reliant not only on the buying and selling that you do, but also on the buying and selling of the particular fund manager that you choose. So you could see where having a lot of turnover within a particular fund could be a disadvantage to owning any type of fund. And you can also see why that eats away at net returns in the way that Jack Bogle talked talked about when we talked about that on Monday. We talked about things that Jack Bogle said and the reasons that active managers underperform, because if they are doing a lot of trading, they are having a lot of realized gains come through at any given time, especially in the short term, then that will reflect in your returns, which is what we do not want. We do not want taxes eating away at our net returns, and that's exactly why we talk about this today, because we are trying to be as tax efficient as possible and minimize our tax burden when it comes to our investing life. Now, index funds, they are tax efficient naturally. Okay, now whether they're in a mutual fund or an ETF, they can still be naturally tax efficient. And here's why. Because index funds simply replicate the holdings of an index. They don't trade in and out of securities as often, so there's not as much turnover going on. Constant buying and selling by active fund managers tends to produce taxable gains, and in many cases, short-term gains that are taxed at a higher rate. So not only are you having less realized gains within the fund, right, you are also having less in the way of short-term realized gains within the fund that would lead you to pay short-term capital gains tax, which is what investors try to dodge if at all possible. Okay, so this will naturally decrease the amount of taxes that you have to pay. Also, since index funds have to buy new lots of securities in the index every time investors put money into the fund generally has hundreds or thousands of lots to choose from when selling a given security, which gives the fund manager flexibility to sell lots that have the lowest tax bite. Or in other words, right, the fund manager is going to sit there and they have bought all these different shares at all these different times and prices, and whenever these cash inflows are coming into the fund, and then when they have to realize the gains or have to go about selling, they can choose which lots of shares are going to have the lowest tax implications associated with them. And that can be a distinct advantage. Now, even though they don't have any control over what specifically the fund owns or does not own at any given time, they can control at what price the fund owns whatever it may own at any particular time, which can be extremely advantageous to investors because they will not have to realize as much in gains that happen within the fund itself. Then these funds will only sell their complete holdings of a specific security if the index itself removes the security, which is a good thing for investors since such sales can result in large capital gains, right? Because an index fund is only going to get rid of a security completely when the index changes, their holdings of a particular security. Now, the reason that this is particularly advantageous is because an index is weighted in some particular way, right? We talked about the Dow Jones being price weighted. We talked about the S&P 500 being market cap weighted. In either case, right, especially with the S&P 500 though, right, the larger and higher price stocks, right, are going to be towards the top of the list. They are going to be towards the top of that index and be the largest holdings within that index, and are far less likely to fall out of the index than companies that are not as large, especially in those market cap weighted indexes. Okay, well, given that that is the case, those smaller companies are going to have smaller weights in the particular index and a higher likelihood of falling out of the index. And so the only way that a fund manager is going to sell all of a particular security is if that security falls out of the index. Well, not only is it not very likely that the larger companies fall out of the index, but it's also not very likely that an index changes very often anyway, right? So if you only have the smaller of the holdings falling out of the index and doing so at a relatively slow rate, then your realized taxable gains are going to be relatively small, and they're far more likely to be long-term capital gains and not short-term capital gains. And because of the way that they trade, right, ETFs may have an additional tax benefit. So if you're talking about, how you want to be as tax efficient as possible, right? The ETF version of an index fund can have some additional tax benefits. When you sell shares of an ETF, you're selling to another buyer as opposed to the fund company. This means that the fund itself usually isn't involved in the transaction and doesn't have to sell any securities, potentially triggering capital gains, right? So the fund itself, when it's an ETF, can continue to hold whatever securities they own at that given time, because you're just transferring ownership of that ETF to someone else. So the fund doesn't have to change what they're invested in or their allocations because they don't have a cash outflow going on like you would in a mutual fund. What's happening with the ETF is you're just transferring ownership to someone else. With the mutual fund, you would be transferring your ownership back to the mutual fund company. And so what they would do is they would sell the shares of whatever it is in order to give you your money back. And that just doesn't happen within an ETF, which keeps you from having to pay more in the way of taxes because there are less realized gains in this particular case. Now, you keep hearing me talk about long-term versus short-term capital gains. Just to give you a quick refresher, right, on the differences between the long-term and short-term capital gains. When you have to pay a short-term capital gain, meaning you realized a gain within a year, right, you are having to pay your income tax rate on those particular gains, okay? Now, that can be any of the particular tax brackets that you may be in. If you're in the 10, 12, 22, 24, 32, 35, or 37% tax bracket, you will have to pay that percentage, okay? But when it comes to long-term capital gains, right, if you're in that 10 or 12% tax bracket, right, that 10 or 12% marginal tax bracket when it comes to your income, if you have a long-term capital gain, you will pay absolutely nothing in the way of long-term capital gains. So if you make between $0 and $78,750, that is as a married filing jointly couple, okay, then your tax rate can be 0% on long-term capital gains. And then for most individuals, because it's up to over $400,000 of taxable income, the long-term capital gains rate is only 15%. So relative to having to pay, 24, 32, 35, 37%, you are in a much more advantageous place. But over $434,550 of married filing jointly income, then you are going to have to pay 20% in the way of long-term capital gains. Okay, so you see that there can be a really big benefit, especially between like 32% and 15%, right? That is a really big difference between the amount of taxes that you will have to pay on a particular gain, right? So obviously you want to be able to take as much in the way of long-term gains as possible, or not realize gains at all and be able to continue to move forward with your growth without having to realize gains. Now, another side of the capital gain that we don't talk about very much is also the capital loss. Now, capital losses, they are extremely common, and you can deduct capital losses from your taxes at the end of the year, from your income taxes. But the issue with capital losses is they are far less likely to occur over the long term than capital gains. So when you're talking about an index fund that is, purchasing these shares of these companies and holding it for a long period of time, and it traditionally going up most years, then realizing a capital loss is not very likely. So we won't jump too far into that. Okay. Now, we've talked about how the index funds have lower turnover, which can positively impact your taxes. But index funds are also going to pay less in the way of dividends. Now, dividends from mutual funds are taxable as income, and most index funds generally produce fewer dividends than actively managed mutual funds within the same respective category. So unless you buy an index fund that's specifically designed to buy and hold stocks that pay dividends, or bond index fund, you aren't likely to hold an index fund that produces income from dividends or interest in a large amount, right? So for instance, the S&P 500 index fund, yes, it pays dividends. Yes, I get paid dividends from an S&P 500 index fund, right? But those dividends are not near as much as they would be if I held, let's say, the Dow Jones index, right? The Dow Jones index likely has a higher dividend yield because those are larger companies, okay? So you are going to have fewer dividends than some other actively managed funds. Even better, if it suits your risk tolerance and investment objectives, you could buy growth index funds. And in buying growth index funds, it is going to even further decrease the amount that you pay in the way of dividends. So if you buy something that like tracks the NASDAQ, right? Because those NASDAQ companies are paying far less in dividends than our S&P 500 or Dow companies. So if you buy a NASDAQ index fund, then you're going to have very little paid to you in the way of dividends, therefore decreasing the amount of taxable income that you'll have because dividends are taxable. So in understanding how index funds work and in seeing how you can be more tax efficient with your investing in index funds, right? Let's talk about particularly what I do when it comes to index funds and my index fund holdings, and really, keep you in the loop as to how you could go about investing your index funds to minimize the tax burden that you could have. Okay, so just via that last point that was stated about dividends. Anything that I own that I know it's going to pay higher in the way of dividends, I would like that to be within a retirement account, not within some basic brokerage account. Now, why is this? Because within a retirement account, I'm either going to have tax deferred or tax-free growth on those dividends, right? Those dividends can be reinvested and there will be tax-free growth of those dividends if it's within a Roth, or tax-deferred growth within some type of traditional account. Okay, so anything that pays a lot in dividends, it is more advantageous to keep it over there, right? Because I do own a couple of ETFs that do pay high dividends, right? To kind of have a little bit better asset allocation. I have some high dividend paying ETFs, and those high dividend paying ETFs are held within these retirement accounts because in being held within those retirement accounts, I can be more tax efficient. Now, as I stated a moment ago, holding growth index funds can be very, very useful, but it can be even more useful if you're holding them within traditional brokerage accounts, regular brokerage accounts, taxable brokerage accounts, because there are going to be very few taxes on those growth index funds because they're not going to pay out much in the way of dividends. So holding them within that taxable brokerage account is perfectly okay because whatever is coming off in the way of dividends, you're going to have to pay very little in the way of taxes. Okay, and if you held it within a tax-deferred or tax-free account, that's perfectly fine too. But what you're not taking advantage of there is the fact that that's going to grow with very little in realized gains or distributions over a long period of time. And in doing so, right, you wouldn't have had to pay any taxes anyway. You want to hold whatever within those retirement accounts, those tax-deferred or tax-free accounts that may have some type of real big realized gains or shorter term realized gains. Because if you hold those there, then you're not going to have to pay taxes on those particular gains or those distributions that may be made to you. But whatever's going to provide the least in realized gains and may have a much higher likelihood of just growing without the realization of gains over a long period of time, that should go into a taxable brokerage account. Because we want to realize as little in the way of gains as possible in order to pay as little as possible in taxes. So like I said, I have higher dividend ETFs within my retirement accounts. I have some more growth index funds within the taxable brokerage accounts, and within the retirement accounts, I have the individual stocks that I own. Now, why would I have individual stocks that I own? Well, some of those individual stocks that I hold, right, they are going to pay dividends, which are taxable, but they won't be taxable within those retirement accounts. Okay, so I take care of that there. Not to mention, right, I'm far more likely to sell an individual stock or rebalance my individual stock portfolio than an index is going to rebalance in that same amount. Okay, so yes, an index is going to be working with a ton of money, right? But their rebalancing relative to the amount that I hold in the index is likely to be smaller than the rebalancing that I might do within my individual stocks. So I can buy or sell my individual stocks within those retirement accounts, IRAs, things like that, and be able to not have to pay taxes on those gains, which is very advantageous to me. And so you have those individual stocks over there. Now, don't get me wrong. I do hold index funds within retirement accounts because sometimes you don't have a choice. Within things like your 401ks, right, you don't have a choice because you have these mutual funds to choose from. Now, naturally, you could choose things that have higher turnover to go within retirement accounts because there aren't going to be taxes related to those gains. But as we've talked about before, actively managed mutual funds, they underperform. Okay, they underperform the indexes, and so I keep it pretty simple within employer-sponsored retirement accounts and just pick the indexes and keep it diversified and some good asset allocation there. And then also within a taxable brokerage account, right, you can also hold some individual stocks that pay no dividends. And you expect to hold for a long period of time. So I'll give you an example of one of those for me. One of those for me would be something like Berkshire Hathaway. Berkshire Hathaway, they repurchase a lot of shares, but they do not distribute in the way of dividends. And I expect to hold Berkshire Hathaway for a long, long, long time because I like the company. It's run by Warren Buffett and Charlie Munger, who are getting a lot of flack this week. But those guys, I still trust them to manage money well. And guys like Greg Abel and Ajit Jain, all those guys, I expect them to be able to grow my money well over the long term. And so I'll hold a company like that within a taxable brokerage account because I know that they aren't going to pay me dividends. They're only going to repurchase shares, right? Because it's more tax efficient to repurchase shares than it is to pay out dividends. And I expect them to grow over the long term and me not have to sell that stock anytime soon. And given that that is the case, any gains that I have, I'm not going to realize them, or at least I'm not going to realize them anytime soon. And so I will just keep that growing there. Okay. The whole idea with all of this tax efficiency stuff is to know how things grow, know how your returns are going to come to you, and then based on what the advantages and disadvantages are of these different types of accounts, choose the account that best fits the particular investment that you want to put into that particular type of account. It's not going to be perfect, right? Trying to put things in certain places because it's going to work out perfect, it doesn't, right? But it can really help to gain the knowledge. It can really help to understand the accounts, understand how you make your returns, and then be able to mesh those two together, and in doing so, minimize your tax burden over the long term. And understand tax advantaged accounts, understand tax advantaged investment vehicles, and be able to put them to use. Because I've seen a lot of people, I used to work as an investment advisor representative, and in doing so, I've seen people hold things like municipal bonds within IRAs or annuities within IRAs. Well, the whole idea of municipal bonds is that they get you a tax break. Well, why would you want to hold something that gets you a tax break within an account that is not going to make you realize those taxable gains anyway? Or why would you hold an annuity which defers taxes on your money within an IRA when that IRA is already going to be keeping your money from taxes, at least deferring those taxes to the future? So making those decisions is very important, because you don't want to add an unnecessary layer of tax efficiency where it is not necessary, because you can end up putting some of the wrong investments in the wrong places. Okay, so specifically with index funds, we'll kind of bring all this back into index funds. I told you what I do, but I want to bring it back to index funds. With index funds, what do we know? We know there's going to be low turnover. We know there's not going to be a lot in the way of taxable gains in the short term. We know that if a particular fund manager has to sell their holdings, they can choose the best lots with which to do so. And they will only sell their complete holdings if a specific security leaves the index altogether, which doesn't happen extremely often. And if it does happen, may only happen in small amounts of that particular index. So in understanding all these things, we see that there are tax advantages to index funds, but we have to understand the types of index funds that we own. And if we go into things like bond index funds, then distributions become a far more important topic here, because distributions, they are going to be taxable to you if held within some taxable brokerage account, and you may have more issues there. But overall, index funds are very tax efficient relative to actively managed mutual funds and ETFs, and you can use them in order to decrease your taxable income and decrease your capital gains that you're going to have to pay year over year when it comes to your investments. So keep them in mind, use them for what they can be used for, and make sure you're not putting them in accounts that are going to be used for having more realized capital gains or distributions and keeping you from paying taxes in that way. So again, what we're trying to do is pay the least we can in taxes by doing it the legal way. And there are many legal ways in which to do it. But we also can't get so bogged down in taxes that we're not investing in good things. Invest in good things first, and then let the tax efficiency come afterwards, okay? But it is very important, and we want our net returns to be as high as possible, and so that's what I'm trying to help you do, and hopefully I've done that within this episode. So thanks for tuning into this episode. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, and be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to create a financial plan that's specific to you and your family's needs and keep you accountable to that plan over the long term, then I can do that. Just go to my website, www.MNOwithDylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as I talk about index fund performance, and specifically the bet that Warren Buffett made with the hedge fund managers. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.